Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update. It's been a while. We've had a lot of construction going on here at the building, and so with a rainy day, we thought we'd jump in here and get the market update completed. As well as trying to get you caught up on what's going on. We're going to do a review of 2023. We're going to take a look at 2024, and it's an election year, how that's going to impact the markets and affect your investments. And we're going to look at the best investments for 2024, how to play the markets to get the most out of it, and we'll talk about how you're positioned going forward. For a year in review, the Dow Jones was up 13% on the year. The S&P 500 was up 24% on the year. The Russell 2000 was up 15% on the year. The NASDAQ was up 23% on the year. All of that mostly because of an end-of-year rally. That end-of-year rally was triggered by the Federal Reserve announcing they're going to lower interest rates next year. It all sounds great that these returns were so great this year, but I want to remind everyone that we're just getting back to where we were at the beginning of 2022. Everyone's excited about the Dow Jones reaching a new all-time high, but it's only slightly higher than it was in January of 2022. So the big drop that we had has been recovered, but we really haven't had any gains over the last 2 years. Now, of course, on your accounts, we are up a little bit, but the overall markets have been challenging for the last 2 years, big down, big up. And this plays into performance, which I think is really important. And I'll pick on one of my clients who wanted to go into an investment recently. And for example, some of the funds have done really well in 2023. One of those funds is the Fidelity Contra Fund. And so Fidelity's been out there. There's a lot of articles out there, all this stuff in the mainstream media talking about how great some of these investments are. Well, that particular investment was up 34% in 2023. And so someone might say, well, 34%, Matt, you're only up 20% on the Copley Tactical Fund. What's going on? Well, we want to look at the performance over the last 2 years. So the Fidelity Contra Fund actually dropped 28% in 2022. And you might say down 28%, up 34%, we're fine. But in reality, you're not fine, because when you lose principal, you have to get a higher return the next year just to break even. For example, if you lose 50% on your money in a given year, you have to get 100% the next year just to break even. So the Fidelity Contra Fund is actually still down 4%. Even though it was down 28%, up 34%, it's still down 4%. So it would need to have an additional 4% increase just to break even. Now, if you compare that to the Copley Tactical Fund, which is only up just over 20% in the last year, well, that fund was only down 11% in 2022. So if you look at the performance over 2 years, down 11%, up 20%, we're actually up 7%. So we've outperformed that by quite a bit. Instead of being down 4, we're up 7. That's an 11% differential. So even though we may not have performed as well as some of the highest performing investments in this year, our main objective is to protect your principal. I'm not interested in having big drops in your accounts. So obviously when the markets come down, we are going to have some negative returns, but we're doing everything we can to protect your accounts from the downside. And we may not get as much on the upside, but if you haven't lost as much, well, that's okay. So all of this big rise in the stock market recently is really driven by the Federal Reserve lowering interest rates. Now, they haven't actually lowered interest rates yet. They've just announced that they're going to lower interest rates in 2024, and this got the market all excited. And of course, some of the beneficiaries of lower interest rates next year is going to be gold. Gold should take off. It's already up 13% in the last year, basically the same as the Dow Jones in gold. So when you look at gold, inflation and interest rates coming back down, it should be a signal that gold is a good investment, but even better investment would be gold stocks, because typically gold stocks go up quite a bit more than gold in an up year. Well, this is a really unusual year in 2023 because gold was up 13%, but gold stocks were barely up at all. In fact, 1%. So how is it that gold went up 13%, but the actual stocks only went up 1%? I can't explain it. In fact, if you went back a year and you told the average advisor that gold's going to be up 13%, you would expect gold mining stocks to be up 20 or 30%. In fact, those companies' profits are going through the roof right now. The price of oil is down 11% on the year, which is a major input cost for these companies to pull the gold out of the ground. And so these companies are just in a really good spot. They're a good buy. Now is a good time to buy gold mining stocks. And so we're going to keep our larger positions in gold and gold mining stocks because we feel like they're very undervalued at this point. Some other areas that, of course, are going to be impacted by lower interest rates and inflation. Bitcoin took off this year, up 150%. Everyone's excited about Bitcoin again and cryptocurrency, but I want to remind you that it's still down 30% from where it was a couple years ago. And so Bitcoin had a huge drop in 2022, and it's barely even made half of the drop back. And so there's still a lot of room there that we can see Bitcoin potentially move up. Again, this is a very speculative investment. The cryptocurrency, it's pure speculation. I'd much rather, I think, be in some of the gold mining stocks that produce actual dividends and profits and selling gold in a tangible product than in a cryptocurrency that may or may not perform well in the coming year. One of the things that will benefit from lower interest rates are bonds. Bonds have really been impacted over the last 2 years, really, and they have not recovered. They're way down. In fact, the 30-year treasuries are still down 30% from where they were. And so the bond market, when you look at that, inflation in the future obviously is a problem because interest rates could come back up, and that affects bond prices. So we still want to completely avoid bonds just because we're worried that there's a potential that inflation comes back. Now, right now, inflation isn't the concern. Deflation is what everyone's talking about, and we're seeing this across the board. You're seeing that rents on apartments and things like that are flat. Rents and leases on office buildings are way down. We're seeing China in full contraction. Their manufacturing and services sector is in contraction. So a lot of the indicators, the leading economic indicators, say that we are already in a recession or we're coming into a recession. You might remember from a previous video that I had said that I believe the recession will start around June of 2024. Looking at current economic indicators, those numbers may get pushed up maybe to March or April of 2024. Now that's looking at just the economic indicators. There is a big thing happening in 2024 that can completely change everything, and that's the election. 2024 is an election year, and there may be a lot of artificial stimulus and things done with the economy in order to help Biden get reelected. And because the federal government is involved in these interest rates, and they've already announced the interest rates are coming down, that will create artificial stimulus. And this may push out a recession. It may push out any recession beyond the election. Now, I am very concerned about the Fed lowering interest rates. Now, they announced it. They certainly can't take it back because the market's expecting these rate cuts. And if they don't get it, that could signal a big crash in the stock market. And so I'm pretty confident that the Federal Reserve will deliver what they promised, which is rate cuts in 2024. But when these rate cuts happen, obviously it's going to help stimulate the economy, just like in 2020 when interest rates came way down during COVID. You saw this big stimulus. But what was the result of that stimulus? It was a lot of inflation. And I expect, even though we're seeing a lot of deflation, we're seeing a lot of recession indicators, we're seeing a lot of contraction right now, and that may persist for the next few months or into 2024. I expect a back half of 2024 to really probably see some good economic results with artificial stimulus coming in. Now, a big part of this stimulus is going to be what we call quantitative easing. See, the government has to roll over $5 trillion in debt at much higher interest rates than what the current rates they are paying. In addition to that, the government's running a $2 trillion deficit. So $5 trillion plus $2 trillion puts us at $7 trillion that has to be monetized. I do not believe for 1 minute the private sector or foreign buyers are going to pick up that $7 trillion. I believe it is going to have to be monetized by the Federal Reserve. And when that happens, you're going to see, just like 2020, a lot of money coming in, a lot of money printing. This will artificially stimulate the economy, but it is going to trigger inflation specifically in the back half of 2024, and we'll probably see that materialize in 2025. As everyone knows, Washington, D.C. is very Democrat Party oriented. More than 90% of the voters are Democrats. The people that work in the Washington, D.C. and the federal government, they're typically Democrats. And I have a feeling that you're going to see a lot of pressure put on the Federal Reserve to lower rates, stimulate the economy, to help Biden. Now, the interesting thing about this is you can go to the election odds and see what the odds are of who's going to win the election. And an interesting note is that if you look at Trump versus Biden, Trump is actually slightly favored in election odds for 2024 in November. However, the Democratic Party is favored. How can that be? How can Biden not be the favorite to win the election versus Trump if the Democratic Party is favored to win the election? Well, I think that shows that the odds makers believe that Joe Biden is not going to be the nominee for the Democratic Party, and that there's a really high likelihood that Biden steps down and another candidate steps in his place to represent the Democratic Party that will ultimately beat Trump in the election in November. And I think that those expectations are potentially what could happen. In fact, if I'm in the party leadership of the Democratic Party, this makes a lot of sense to me because we want to get through the primaries. And if Biden steps down after that process, what happens is the Democratic Party leadership gets to select who they're going to put in place to run against Trump. And I think that that is a real possibility. Now, whether it's Trump or Biden or someone else, I think that if you look at the economy, we are seeing a lot of recession indicators that are going to have to be dealt with, whether it's in 2024 or they manage to create a lot of artificial stimulus to push some of the recession out to 2025. We are seeing record numbers of bankruptcies among companies. We're seeing, it's just a weird mix of stagflation type numbers where you see a lot of recession, deflation indicators, and then you see other things that are inflationary. And then you see things that are a mix. And this is very, very reminiscent of the 1970s. In fact, if you look at the 1970s, one of the interesting things about the 1970s is there was a big spike in inflation in the early 1970s. And then that inflation came way down. And there was a bit of a recession in 1974 and 1975. You saw interest rates come way back down, and everyone thought everything was fine. And then all of a sudden inflation went wild, and it went way up. In the late 1970s all the way into 1981, inflation was absolutely off the charts, the highest it's ever been in the United States. And ultimately interest rates had to be raised to 20%, in fact above 20%, in order to get inflation under control. And it's a little bit creepy looking at these charts and seeing what the current numbers look like and what they look like in the 1970s. Now, what happens, of course, during a recessionary period, you get bankruptcies, you get companies that are struggling, and you see these signs. And just an anecdotal sign from an advisor that I am good friends with, that I speak with back in the Midwest. He's in the process of looking for a new car, and so he's looking for a new Mercedes-Benz expensive car, and he's looking at a car that has a sticker price of $150,000. And right now the dealership is looking to sell him this car at $95,000. That's a huge discount on a brand new car. $150,000 sticker price, he can buy it for $95,000. That is a sign of deflation. Now, there's also a lot of signs of inflation. One example here, and I'm sure you've seen this on your home insurance renewals, insurance rates are going through the roof. In fact, I was just speaking with one of my clients on the phone earlier today, and his home insurance, which was less than $2,000 a year, his new bill is over $5,000 a year for home insurance. And we're seeing this for a lot of people, especially people that live in the East County that can be affected by wildfires. You're seeing companies drop your rates. You're seeing all these increased costs. Now, a lot of this has to do with the state of California rules, regulations on the insurance industry that's driving up costs. But one other area that's causing insurance rates to go up is these companies, what they do with your premiums is they actually buy safe investments in order to backstop any insurance claims. Well, the problem is a lot of these investments that they purchased, maybe mortgage-backed securities, or maybe they bought long-term treasuries. The interest rates have gone up so much in the last year that the mark-to-market value on those securities is quite a bit less than what the current amount that they paid for them. So if there was a big insurance claim like a wildfire, an earthquake, there's just simply not enough money there to cover the cost. And so they're having to raise premiums quite a bit to cover that. And of course, this is how the banks are in trouble. In fact, all the banks are insolvent right now. And I'm not talking about First Republic and Signature and all the ones that had a problem earlier this year. I'm talking about Chase and Bank of America and Wells Fargo. Those banks are all completely insolvent as well. And the reason is they're holding a lot of paper, a lot of loans that are maybe at 2.5%, 3.5% on 30-year fixed rates. And the current rates are 6% to 7%. And so those underlying mortgages are worth way less than what they're showing. Now, the banks get away with being able to mark to maturity, not mark to market. The insurance companies can't do that because they could have a claim at any time. The banks are assuming that they're not going to have a run on the bank and people aren't going to rush to get their deposits, and they're assuming they can hold these mortgages all the way to maturity. Over the next 30 years, people will keep making their payments and they'll all eventually all go well. But that's a potential problem. And now, it's very deflationary that all of these mortgages are insolvent. But it's also very inflationary, because I have a feeling that if there was a problem, if there was a bank run, for example, the government would just bail out all these banks, and that's very inflationary. So these are the things we're seeing. A few other things that I've seen here recently, especially here in California, we're seeing a lot of things. For example, effective January 1st, undocumented immigrants actually can now qualify for Medi-Cal benefits, for medical benefits here in California. Now, this is both inflationary and deflationary. So people will say, well, undocumented immigrants, they're going into the emergency room, so now they'll be able to get coverage, outside of the emergency room, so everything's going to be fine. But the flip side of that is there's probably going to be a lot of undocumented immigrants that come from other states and other areas to California, because now, hey, we can get medical insurance in California, which we can't get anywhere else in the country. And of course, this will have a big impact on our healthcare system, and that's because there's a limited number of doctors and nurses and things like that, and it's already impacted. I mean, if you go to schedule an appointment for a procedure, you know how long it takes to actually get in to see the doctor, and this will probably impact it even further, and of course, raise the costs, which is inflationary. Those costs are going up. Another example of stagflation, really mixed data where you see deflation and inflation, is the recent raise in fast food worker wages. I think they were getting paid around 16 something an hour, and now it's up to $20 an hour, and it's scheduled to go up to $22 an hour in the future. And so when you see these big increases in wages among fast food workers, that is inflationary. They're going to have more money that they're going to go out and spend in the economy, but it is also deflationary. And the reason it's deflationary is a lot of those fast food workers are going to lose their job. And so, for example, let's look at pizza delivery drivers. Companies like Pizza Hut, Domino's, they're not going to continue to pay their pizza delivery drivers $22 an hour. They'll probably come up with some kind of an agreement with Uber Eats or with some other kind of delivery service that will deliver the pizzas, and they don't have to pay their employees. It'll be an independent contractor at Uber or DoorDash that'll actually deliver the pizzas. So all those people that did have jobs at $16 an hour, now that it's been raised to $20 an hour, some of those people are going to get $20 an hour, but a lot of those people are just going to lose their job. And so that is deflationary. So that's an example of a lot of mixed data that we're seeing right now. So with all this data, how do we play 2024? Well, it's very similar to the same recommendations that we had in 2023 with a few changes. First of all, we want to take advantage of these high interest rates as long as we can. They are coming down, so we are seeing some of the interest rates come down on the multi-year guarantee products. So things that maybe were 6% are down to 5.25%. So we're seeing some adjustments, but we can still get above 5% on guaranteed money that can be locked in and guaranteed for many years. So take advantage of those high rates while they're available. The Federal Reserve has already announced that rates are going to come back down next year, and so the expectation is lock in these rates while you can, and if rates come back down and maybe they're down around 3.5% or 4%, well, you're sitting tight collecting 5.5% on part of your money. And that's insured, it's guaranteed, you can't lose. This is a chunk of money that is protected. So you want to have some of your money in those positions that are safe, that are getting guaranteed interest. And then after that, we want to take a look at these buffered indexes. They've been some of the best investments we've had this year, fantastic results. And this is where you can invest in the S&P 500 with insurance. And so when you start looking at investing in the stock market, it's a bubble. There's a lot of problems with the stock market at this point. Now, if you look at the actual market in 2023, people get excited and say, oh, the Dow was up 13%, the S&P was up 24%. But if you take out the top companies, like for example, the S&P 500, if you just take out what they call the Magnificent Seven, which is the 7 largest companies, the rest of the market didn't do anything. It was barely up at all. It was flat. And so when you start looking at these numbers, those companies are driving all the returns, and they're very overvalued. They're expensive. So does that mean that they're going to crash? No, they can keep going up. The market can be an even bigger bubble. You know, we look at 1998, for example, the market was in a bubble. The PE ratios were very high, but the market kept going up all through 1999. It kept going up and up. So we can take advantage of the S&P 500 performance, but we can also include some insurance. So the current one that we have now has a 23.9% cap. So you can make up to 23.9% return over the next 2 years, which is a great return. Now you give up everything above 23.9. So if the market's up 30 or 40%, you're only going to get 23.9. But that's okay because we're able to get a 20% insurance policy. So if the market crashes, you get reimbursed for your losses. In fact, you can actually make money on the way down to that 20% because it offers an inverse return. So that's really an incredible product. If the market's down 10%, you can make 10%. And so we definitely want to take advantage of that momentum, but we want to have the insurance protecting us. Now, of course, the next thing we want to definitely look at are value stocks, companies that are making real profits in areas of necessity, things that we need. We all need to eat. We need to put gas in our car. Those will do well. And we also want to understand that even though I believe that we have a deflation problem in the first half of 2024, I think inflation's coming back, and it's going to come back in the back half. And we don't know when that's going to happen. We don't know when that's going to be triggered. That's probably going to be triggered once the Federal Reserve announces they're actually going to lower interest rates. You're going to see this, and you don't want to wait until that happens. You want to get out in front of that. So you want to have a bunch of investments that do well in an inflationary environment. These are companies in agriculture and energy, precious metals. These are the places that you want to be because we know it's eventually going to get there. We just don't know what the timing is. So you want to have those positions in place. So if you have the MIGA, the guaranteed interest, you have the buffered index where you're in the S&P with some protection, then you've got the value stocks and the inflation hedges. Everything's going great. I am going to add one other thing this year, which I think is something we should definitely take a look at. It's been doing fairly well in 2023, but I think it's going to do even better in 2024, and that's international stocks. See, if the US dollar, which is down a little bit in 2023, starts to continue this trend down, most likely we're going to see international stocks perform very, very well. If you go back after the dot-com crash from 2001 to about 2011, international stocks just really outperformed US stocks. They did very, very well. And since 2011, it's been the opposite. US stocks have really outperformed international stocks, and international stocks really haven't done much over the last 10 years. And so I think that you can see a change where the international stocks will start performing a lot better, especially if the dollar starts to come down. And when we focus on international, we want to focus on specific areas of the world. You may notice in the Copley Tactical Fund, we've actually made some recent changes in the last few weeks to take advantage of these opportunities and discounts in the international stock market. So we're focused on countries like India, countries like Indonesia, countries like Brazil and Argentina. These are countries that produce a lot of commodities. They produce a lot of things. And they're a little bit neutral between the US versus Russia, China thing that's going on in the world. So India is taking in all of Russia's oil. They're sending it out to the rest of the world. They're refining it and the whole bit. So it hasn't stopped India one bit. And they're a little bit neutral between, they've got problems with China, just like they got problems with the US. So they're a little bit neutral. So ideally, when you have a geopolitical conflict in the world, you want to invest in countries that are neutral between the conflict, that are selling things to both sides. One opportunity we definitely want to keep our eyes on is artificial intelligence and future technology. And I don't want to get crazy investing in this right now because it's a bit of a bubble. A lot of these stocks have been run up in anticipation of what's going to happen in the future. I really do believe this AI boom is real. You're going to see so many things. I mean, if you think about some of this technology and what it can do, if you think, for example, about going to your doctor, and you may not go to an actual person, you'll go in and you'll have an artificial doctor who can actually look at all of your reports and look at your blood work and look at your MRIs and actually give you a diagnosis that's better than a human doctor. And they've proven this. They've already shown that artificial intelligence is better at looking at these MRIs than actual doctors. And so they're going to know all of your previous conversations, where your current doctor will forget all about what you talked about last time. Well, this artificial intelligent doctor is going to know all those things. And of course, there'll still be a human element in what we're doing, but that's an example of artificial intelligence being better. They're using artificial intelligence to code all kinds of different software programs. And so the actual AI is doing the work. And I can see a future where there's chips in our phone. When we walk through the grocery store, the phone's going to tell the refrigerator, which also has a chip in it, that you're in the grocery store. And then the refrigerator is going to scan the inside of your refrigerator and tell your phone what products that you need to pick up. I mean, this is the kind of stuff that we're going to see. I think there's a real opportunity here. However, I do think in the current economic environment, we just have to be patient. In the event that we do have a big drawdown in the market, there's a big crash, which I don't expect. I think 2024, with an election year and the Fed coming in with lower rates and stimulus, they're going to kick the can down the road on a lot of this. But when the inflation really starts to pick up, maybe 2025, and we start to see a real problem with the markets, and we do have some kind of a crash at some point, that may be a really good opportunity to start bottom fishing in some of these artificial intelligence and technology names. We're not there yet, but it is something we're watching, and so we're excited about potentially getting aggressive in those areas when the timing is right. I hope that was a good market update, and I hope to see you all in our Mission Valley office very soon.